Dividend income from $10,000. It's not what you think. You've got $10,000 sitting in a savings account, or maybe you just got a bonus or tax refund, and you're scrolling through that investment forums or YouTube videos about dividend investing. And you see these claims about creating passive income, getting paid just for owning stocks, building dividend income streams that cover your expenses. The narrative is seductive. Invest in dividend-paying stocks, collect quarterly checks, watch the passive income roll in without working. So you start doing the math. Average dividend yields are around 3 to 4%. On $10,000, that's $300 to $400 a year. Okay, not life-changing yet. But what if you reinvest those dividends and the positions grow? What if you add to it over time? The compound growth calculator shows some impressive numbers over decades. This could actually work, you think? Maybe this is the path to financial independence everyone's talking about. My name is Jack, and I spend way too much time analyzing dividend investing strategies, studying what actually happens when people pursue passive income through dividends versus what they expect to happen, and specifically trying to understand why so many people are drawn to dividend strategies, even when the math often tells a very different story than the marketing does. And what I've discovered is that dividend income from $10,000 is nothing like what the popular narrative suggests. Not necessarily worse, but fundamentally different in ways that most people don't understand until they've been doing it for years. Because here's what nobody tells you up front. Dividend investing isn't really about the passive income, at least not for decades. It's about total return, tax efficiency, behavioral psychology, and opportunity costs. And the $10,000 decision you make today will have very different outcomes depending on whether you actually understand these dynamics or whether you're chasing the passive income dream without seeing the full picture. So if you're considering putting $10,000 into dividend stocks, or if you've already started down this path and you're wondering if you made the right choice, or if you're just trying to understand why dividend investing is so controversial despite being so popular, this is for you. Because understanding the reality instead of the fantasy might completely change your strategy. The actual dollar amount that surprises everyone. Let's start with the number that nobody really emphasizes in the dividend investing content. What $10,000 actually generates in dividend income, in real dollars, that you can spend. If you invest $10,000 in a diversified portfolio of dividend-paying stocks with an average yield of 3.5%, you receive $350 per year in dividends. That's about $87.50 per quarter, or $29.17 per month. $29 per month. That's the passive income from $10,000. That's what you're building toward, and I want you to sit with that number for a moment, because it's shockingly small compared to what the passive income narrative suggests. That $29 a month doesn't cover your phone bill. It doesn't cover groceries. It doesn't meaningfully change your financial life in any way. It's not passive income you can live on or even notice. It's basically a rounding error in a monthly budget. Now, the defense dividend investors immediately jump to is, but Jack, you reinvest those dividends and they compound. You're not supposed to live off $10,000 in dividends. You're building a portfolio over decades. And that's absolutely true. But that's also admitting that dividend investing isn't really about passive income for most people. It's about accumulation over time, which is the same as any investment strategy. Here's where the math gets interesting, though. If you reinvest those $350 dividends annually and the portfolio grows at 8% total return, dividend yield plus price appreciation, your $10,000 becomes about $21,600 in 10 years. Now you're generating about $756 a year in dividends, or $63 a month. Still not life-changing, but starting to be noticeable. At 20 years, that $10,000 becomes roughly $46,600, generating about $1,631 annually, or $136 a month. Now we're talking about something that might cover a utility bill or grocery budget. At 30 years, you're at approximately $100,000, generating $3,500 annually, or $291 a month. That's starting to feel like meaningful passive income. But notice the timeline. It takes 30 years for your initial $10,000 investment to generate monthly income that might actually matter to your budget. 3 decades. And that's assuming you never need the money, never have an emergency, Never deviate from the plan. This is the reality that the passive income through dividends content doesn't emphasize. For the vast majority of investors, dividends aren't meaningful income for decades. They're a reinvestment mechanism during the accumulation phase, not income you can actually use. The total return misconception. Here's something crucial that dividend enthusiasts often miss. Dividends aren't free money. They're not a bonus on top of stock price appreciation. They're literally a transfer of value from the company to you, and that transfer reduces the stock price by exactly the dividend amount. When a company pays a $1 dividend, the stock price drops by approximately $1 on the ex-dividend date. You received $1 in cash, but your stock holdings are now worth $1 less. The total value is the same. You just changed the form from stock value to cash. This means that a stock yielding 4% isn't necessarily better than a stock yielding 1% or 0%. What matters is total return, the combination of dividends plus price appreciation. And historically, total return has been relatively similar across different dividend strategies. High dividend stocks, 5% plus yields, often have lower price appreciation, sometimes even price depreciation. Low or no dividend stocks often have higher price appreciation. The total return frequently ends up in a similar range. So the question becomes, would you rather have your returns as dividends that trigger immediate taxes in taxable accounts, or as price appreciation that compounds tax-deferred until you sell? For most investors in accumulation phase, having returns come as price appreciation is actually more tax efficient. You don't pay taxes until you choose to sell, and even then it's capital gains rates, which are often lower than ordinary income rates. Dividends in taxable accounts are immediately taxable at ordinary income rates. For most dividends, qualified dividend rates, which are still taxes you pay every year. That tax drag compounds over decades into very significant amounts. I ran this calculation once. $10,000 invested in a 4% dividend portfolio in a taxable account versus a 0% dividend growth portfolio, both with 8% total return, over 30 years with taxes accounted for. The growth portfolio ended up with about 15% more wealth after tax than the dividend portfolio because of the cumulative tax drag from annual dividend payments. The dividend investor felt wealthier because they had this psychological experience of receiving income. But they ended up with less actual wealth. The total return principle. Dividends aren't magic. They're just one form of return. Focus on total return, not yield. And understand that in taxable accounts, high dividends often mean lower after-tax wealth. The opportunity cost of dividend focus. Here's something that dividend-focused investors rarely consider. By specifically seeking dividend-paying stocks, you're excluding a huge portion of the market, and that exclusion has significant opportunity costs. Many of the highest growth companies pay zero dividends. Amazon didn't pay dividends during its explosive growth phase. Google doesn't pay dividends. Tesla doesn't. These companies reinvest profits into growth rather than distributing them to shareholders. And historically, that strategy has generated higher total returns than comparable dividend-paying companies. When you commit to a dividend-focused strategy with your $10,000, you're essentially saying, I'm willing to give up exposure to all the highest growth companies in exchange for receiving a small quarterly payment. And in many market environments, that's a very expensive choice. From 2010 to 2020, the S&P 500 Growth Index, low dividend stocks, outperformed the S&P 500 Value Index, high dividend stocks, by a substantial margin. An investor who missed that growth because they were focused on dividends left enormous returns on the table. Now, there are also periods where dividend stocks outperform. This isn't about one strategy always being better. It's about understanding that a dividend focus means you're making a specific bet about which types of stocks will do well, and that bet comes with an opportunity cost. For a $10,000 investment, that opportunity cost over 10 to 20 years could easily be $3,000 to $10,000 in foregone returns depending on the market environment. That's meaningful money you're potentially giving up for the psychological benefit of receiving quarterly dividend payments. The portfolio construction principle. Unless you have a specific reason to focus on dividends, a diversified total market approach that includes Both dividend and non-dividend stocks is usually optimal. You get exposure to all sources of return rather than limiting yourself to one subset of the market. The dividend cut reality. Here's a harsh truth about dividend investing that doesn't get enough attention. Dividends can be cut, suspended, or eliminated. And when that happens, it's usually when you can least afford it. Companies generally cut dividends during financial stress, recessions, industry downturns, company-specific crises. And these are exactly the times when you might actually need that passive income you've been counting on. During the 2008 financial crisis, over 100 companies in the S&P 500 cut or eliminated dividends. The investors who had built their strategy around those dividend payments suddenly lost significant income right when the economy was falling apart, and they needed it most. During COVID in 2020, major companies across multiple sectors, airlines, retail, energy, cut dividends. The passive income that investors thought was reliable vanished exactly when they might have needed it. And here's the cruel part. When dividends get cut, the stock price usually drops significantly because dividend-focused investors sell, creating a double hit. You lose the income and you lose capital value simultaneously. This is very different from the narrative of reliable passive income. Dividends aren't guaranteed. They're not contractual obligations. They're discretionary payments that companies can eliminate whenever management decides it's necessary. For your $10,000 investment, this means that the $29 monthly income you're counting on could disappear without warning. And if that $10,000 has grown to $50,000 over the years and you're now depending on the $145 monthly dividend income, having it cut by 50% or eliminated entirely could actually affect your lifestyle. The reliability principle. Don't build your financial plan around dividend income being guaranteed or stable. It's not. It's variable, discretionary, and most vulnerable exactly when you need it most. Factor this risk into any dividend strategy. The behavioral trap of income focus. Here's a psychological dynamic that I've watched play out repeatedly. Investors become so focused on maintaining or increasing dividend income that they make poor portfolio decisions. They hold on to dividend stocks that have declined significantly because selling would mean losing the dividend income. They refuse to rebalance out of overweight positions because those positions are generating the most dividends. They pass on better opportunities because those opportunities don't pay dividends. The dividend income becomes the metric they're optimizing for, even when optimizing for total return would leave them wealthier. It's a behavioral trap where the psychological satisfaction of receiving regular payments overrides rational decision-making. I know someone who held on to a declining dividend stock for years, watching it lose 40% of its value because it still pays the dividend. The dividend was $4 per share, but the stock dropped from $80 to $48. They collected maybe $20 in dividends over that period while losing $32 in capital. But because they were focused on the income, they didn't see how irrational the holding was. This is loss aversion combined with income anchoring. Once you're receiving dividend income, cutting that income by selling feels like a loss, even if selling and reinvesting would generate better total returns. For your $10,000, this trap means you might end up with a suboptimal portfolio that you're reluctant to change because you've become attached to the dividend income it generates, even if that income is relatively trivial and the portfolio is underperforming. The behavioral principle. Focus on total wealth building, not income generation. If your goal is growth, optimize for growth. Don't let the psychological appeal of dividends distract you from building the most wealth. When dividends actually make sense. Okay, so I've been pretty critical of dividend investing, but let me be clear. There are situations where dividend focus is absolutely the right strategy. It's just not what most people starting with $10,000 should be doing. Dividends make sense when you're actually living off the income. In retirement, when you've accumulated significant capital and you need cash flow without selling positions. At that stage, having stocks that generate $50,000 or $100,000 annually in dividends provides predictable income without forcing you to sell shares. Dividends make sense when you're in a very low tax bracket where the tax drag isn't significant. If you're retired with minimal other income, qualified dividends might be taxed at 0%, making them very attractive. Dividends make sense in tax-advantaged accounts where the tax drag doesn't apply. In a Roth IRA or traditional IRA, receiving dividends and reinvesting them doesn't trigger immediate taxes, so the tax efficiency argument against them disappears. And dividends make sense for investors who genuinely won't stick to a strategy unless they're receiving regular psychological reinforcement. If seeing quarterly payments is what keeps you invested during downturns, then the behavioral benefit might outweigh the mathematical disadvantages. But for most people starting with $10,000 in their 20s or 30s or even 40s, in taxable accounts trying to build wealth, dividends probably aren't optimal. A total market approach that's tax efficient and maximally diversified will likely build more wealth over time. The situational principle: dividend investing is a tool, not a universal strategy. Use it when it matches your specific situation and goals, not because the passive income narrative sounds appealing. What to do with your $10,000? So, what should you actually do with $10,000 if dividend income isn't the answer? Here's the simple strategy that's boring but effective. If you're young and building wealth, invest in a total market index fund or S&P 500 index fund. Diversified exposure to all sectors, all company sizes, dividend and non-dividend stocks. Focus on accumulation and total return, not income. Hold in Roth IRA if possible for tax-free growth. If you're in your prime earning years, maximize 401k contributions, then use additional funds for a 3-fund portfolio: U.S. stocks, international stocks, bonds. Let the asset allocation shift over time as you age. If you're approaching retirement, start increasing bond allocation for stability, but still maintain significant stock exposure. You might start including some dividend focus as part of your equity allocation, but not to the exclusion of growth stocks. If you're in retirement, now dividend focus makes more sense. Build a portfolio of quality dividend stocks that generate the income you need, supplemented by bonds for stability. But even here, total return matters more than yield. The reality is that dividend investing is one tool among many, and it's rarely the optimal tool for someone with $10,000 trying to build wealth. The passive income it generates is too small to matter for decades. The tax drag reduces long-term wealth, and the focus on dividends can lead to suboptimal portfolio decisions. The simple principle: focus on building total wealth as efficiently as possible for as long as possible. Then, when you actually need income, you can either generate it through dividends or by selling small amounts of a diversified portfolio. Both work, but one might leave you with substantially more wealth. The truth about financial freedom. Look, I understand the appeal of dividend investing. The idea of getting paid just for owning stocks, of building passive income streams that eventually cover your expenses, of achieving financial freedom through dividend checks, it's a compelling narrative. But financial freedom doesn't come from the monthly dividend payments on $10,000 or even $100,000. It comes from accumulating enough wealth, through whatever means are most efficient, that you have options, that you can choose to work less or differently or not at all. And that wealth accumulation is usually maximized by focusing on total return, not yield. By being tax efficient, by staying diversified, by not limiting yourself to dividend-paying stocks because you're chasing the income narrative. Your $10,000 is a starting point. If you invest it wisely, reinvest all returns, add to it consistently over time, and focus on building total wealth rather than generating income you won't need for decades, that $10,000 could become $200,000 or $300,000 or more over 20 to 30 years. At that point, when you have substantial wealth, then you can decide how to generate income from it. Dividends might be part of that strategy, but the focus from now until then should be on the building, not on the income from the building phase. The dividend income from $10,000 isn't what you think. It's not passive income that changes your life or brings financial freedom. It's $29 a month that you should probably reinvest anyway. And the focus on that $29 might actually prevent you from building the wealth that eventually does bring freedom. So invest your $10,000 wisely, but don't get seduced by the dividend income narrative. Focus on total return, stay tax efficient, remain diversified, and understand that wealth building is about the long game, not the quarterly payment.